Hello and welcome to this Partners Tax webinar, designed to give you an overview of the Vespa contractor strategy. We'll cover a range of topics during this webinar. We'll look at how the world of contracting has evolved and changed, and how HMRC have tried to keep up with those changes, looking at various rules and anti-avoidance legislation, including recent changes introduced in the Finance Act 2014. We'll also look at the various options that remain open to contractors, and specifically the Vespa contractor strategy, which we'll break down into simple terms, looking at how it works, who it might be suitable for, and the costs involved. Finally, we'll outline the next steps if you're interested in proceeding further with Vespa. It's important to point out at the start that while this webinar includes a lot of information which may enable you to assess whether Vespa may be suitable for you, the information provided is by necessity generic, and as the precise circumstances of each individual contractor may differ, the contents of this webinar do not constitute tax advice, and you should obtain separate independent advice if appropriate. Over the past few decades, the UK's workforce has changed almost beyond recognition. From the 1970s, when almost all workers worked for large firms, through to the late 1980s, when increased mobility of the workforce, coupled with more flexible needs of companies, led to an explosion in short-term contract workers, through to the end of the 90s, by which time hundreds of thousands of contractors were working in the UK. In July 2014, there are estimated to be in excess of 4.5 million contractors in the UK, of which 1.7 million are professionals. The increase is partly due to the recent credit crunch and subsequent recovery. By the end of next year, this number could have increased to exceed those employed in the public sector. Along with the increase, an entire support industry has evolved to support contractors' needs, from accountants to umbrella firms, insurers, and many other types of service provider. So, how are all these millions of contractors choosing to deliver their services? Well, historically, the option of choice, particularly for blue-collar workers or tradesmen, has been self-employment, and many contractors still choose to work on a self-employed basis. The key point to mention about this option is that the business and the person are classed as the same legal entity. So, say if Brian is working on a new office block as his self-employed engineering business and it's flooded due to Brian's error, the client chooses to sue. All of Brian's personal assets are on the line. There is no legal separation between Brian, the person, and the business. Brian also holds responsibility for the running and administration of the business, having appropriate insurance, maintaining records, preparing accounts, and completing a self-assessment return. He will also personally pay NICs and income tax on any profit that he's made. That is Brian, if he chooses to be a self-employed worker. Brian could choose to work for an umbrella company. The umbrella company market is saturated with businesses, all aiming to provide professional employment services to contractors. In essence, the contractor becomes an employee of the umbrella company. So, had Brian chosen to join an umbrella company, he would have been protected by the umbrella company's limited liability status in the event of his work causing flooding in the building. Brian also would have had other benefits of being employed by an umbrella company, such as systems provided to automate tedious tasks like invoicing and payroll, and cover under the employer's insurance policies, as Brian isn't in a particularly high-risk job. The primary drawback of this option is the tax consequences. The umbrella company pays employers' NICs. The individual pays income tax and employees' NICs. All of these taxes are covered from within the gross contract value of the contractor, along with the umbrella company fees. Brian, as an umbrella contractor therefore, would enjoy the lowest return of all the options open to him. Some umbrella companies have sought to increase the tax efficiency of their services, with substantially increased non-taxable expenses payments. However, if these expenses cannot be substantiated with valid receipts, then the contractor is exposed to a tax risk. Another way for Brian to gain limited liability status is to incorporate his own personal services company, commonly known as a PSC. Brian would create a PSC, Brian Engineering Limited, with himself as the director and owner of all the shares in the company. In this case, the business, Brian Engineering Limited, and the contractor, Brian, are two different legal entities, and in the event of the flooded building, it would be the company, not Brian, that was at risk. Brian's liability would be limited to the total value of what he paid for the shares. Other benefits include the option to extract dividends rather than take a salary. Dividends are taxed at different rates and do not attract national insurance. This can be a considerable saving. The primary downside is that it's hard work running your own company in a proper and compliant manner. There's lots of admin and the engagement of advisors like accountants. Finally, as we'll see later, there are tax risks associated with running a PSC, depending upon the circumstances. Combining the benefits of a PSC with the ease of use of an umbrella, essentially the managed service company provider creates, runs and operates the service company on behalf of the individual, Brian, leaving him to get on with the job and enjoy the reduced tax and NIC's liabilities associated with dividends. However, MSCs were explicitly targeted by HMRC in 2007 and essentially legislated out of existence. Brian could become a partner in a partnership. Partnerships are probably the least common vehicle for contracting and as such don't feature much in this webinar. Traditional partnerships don't have limited liability status, and the partners are just taxed as self-employed individuals, whereas limited liability partnerships, or LLPs, do have limited liability, but the tax treatment is the same. Brian could consider a tax mitigation strategy. Over the years, there have been numerous different tax planning arrangements marketed to contractors. Varying in specifics, they typically involve common elements: a small taxable salary in combination with non-taxable payments, such as loans. As with any tax planning, critical to its success is the quality and detail of the advice obtained and the expertise of the implementation. This is where partners come in with the VESPA strategy, which will be discussed in detail later. As options for contractors have evolved, so too has HMRC's response, with new legislation being introduced to counteract what HMRC see as tax avoidance measures. To understand the legislation, let's look at a different example: David, an IT consultant. In the mid-90s, David began working for clients through various recruiters, who all operated their own payroll and paid David as a temporary employee of their recruitment business. Then some recruiters realized they could save the costs of payroll administration and the cost of employers' NICs by asking David to work as a self-employed contractor, also enabling David to pay lower rates of NICs. The work David did didn't change. He worked in the same office and team as the employees of his client, used the staff canteen, and was told what to work on by his employed boss. This isn't being self-employed in the eyes of the HMRC. For an individual to be truly self-employed, they should have autonomy over where and how the work is carried out, and they should bear some degree of commercial risk. HMRC introduced agency legislation to combat this scenario. Under these rules, various tests are applied to determine whether David is actually acting as a pseudo-employee of the client. If he is, he'll be taxed as an employee rather than a self-employed person. These rules have been tightened again in the Finance Act 2014 and pose a considerable risk for those falsely claiming to be self-employed. In the late 90s, David, increasingly frustrated with the amount of tax he was paying under PAYE with his recruitment agency, decided to set up a PSC, David Limited, which invoiced the agency for his services, who paid him gross, with him able to make a little extra profit by using the flat rate VAT scheme. David was able to take more money home, pay tax later under self-assessment at a lower rate, and wasn't paying any NICs either. Otherwise, everything was as before. David had been at the same client for a couple of years, working in the same team, and still being told what to do by his client boss. HMRC saw this as tax avoidance by the use of personal services companies, and moved to legislate against PSCs such as David Limited. IR35 was the result. IR35 operates to identify contractors, i.e. workers delivering their personal services to clients who don't work directly for the client, but rather via an intermediary, and to all intents and purposes act like the other employees of the client. If these tests are met, then the individual, David, is deemed for tax purposes to be an employee of the client and will be taxed as such. The effect is to reverse the benefits of the company, i.e. the reduced tax on dividends and avoidance of NICs. It's always the reality of the working arrangements that will be the deciding factor in any IR35 challenge, rather than any tricks introduced into the paperwork, although many companies may offer IR35 reviews and tweaks. In terms of enforcement, IR35 is a real risk to contractors using personal service companies. Tired of the administration of running David Limited, David signed up with a managed service company named Mountain. Mountain created him another company, David MSC Limited, and did all the company administration work for him. David could continue to enjoy the tax benefits of a limited company, but with no hassle, and the fee he paid Mountain was no more than he'd previously paid his accountant. Mountain's business flourished, and it ended up managing many thousands of companies. HMRC moved to close this activity, which it perceived as avoidance on an industrial scale. In 2007, the MSC legislation was introduced, effectively deeming any payments received from the MSC by David as employment income. The outcome for David is similar to being caught by IR35. The claimed tax benefits are reversed. In 2008, the legislation was given more teeth by enabling the tax debt of MSCs to be transferred to David, other directors, and associated people. So, if David thought he could be clever by letting David MSC Limited go bust when the PAYE bill arrived, he was sorely mistaken, as HMRC simply transferred the debt to him. In fact, the impact and risk of the managed service company legislation and the associated debt transfer provisions are so severe that its introduction effectively removed this option from the list of those a contractor may choose. In the unlikely event that you're offered a service in which a company is set up and run for you, do not be seduced, as the tax risk is unimaginable. It's also worth mentioning that in the unlikely event that you're considering trading via a partnership, you should be aware that the IR35 and MSC legislation apply equally to partnerships as they do companies. The risk and the consequences of getting the self-employed judgment wrong are just the same. There are a number of test cases that can help us see the effects of the legislation in practice. If you'd like to read more about these cases, you can download a fact sheet from the Resources tab below. Correctly assessing your employment status is key. Getting the judgment wrong can be significant from a tax perspective. HMRC provide a rudimentary online tool to help you assess whether you are employed, self-employed, or uncertain. Before that, have a think about these questions. Do you genuinely consider yourself to be self-employed? Do you have complete freedom regarding how to complete your work? If a job goes wrong, are you required to fix it at your own expense? If you work alongside other employees of the client, how different is the nature of the way that you work on a day-to-day basis? If you're really confident that you meet the self-employment test, then you may choose to deliver your services on that basis, remembering your personal assets and the assets of your business are seen as one legal entity, and remembering that if HMRC disagree with you, the tax risk sits with you and you alone. Just to pull out some further key legislation for contractors. Firstly, disguised remuneration. Simplistically speaking, this legislation catches arrangements where there are three parties involved: an employee, an employer, and a third party, such as a trust, and where the third party makes a payment, including a loan, available to the employee. If this is the case, the loan is taxed as employment income under pay-as-you-earn, negating any tax benefit. While the VESPA contractor strategy does involve both a trust and loans, it's been designed so that it is not caught by the disguised remuneration legislation. Secondly, DOTAS, the Disclosure of Tax Avoidance Schemes Regulations. Essentially, this was HMRC's early warning system for tax avoidance schemes. Providers of certain tax planning had to inform HMRC of how the scheme worked, provided certain tests were met. HMRC then issued a scheme reference number to be included upon the self-assessment returns of the individuals. HMRC have on occasion rapidly passed new laws to combat schemes which it has found particularly objectionable. However, in the Finance Act of 2014, HMRC also received new powers to issue accelerated payment notices to individuals that have used DOTAS schemes. Under these powers, HMRC may demand the disputed tax associated with the DOTAS scheme from the individual up front, then have the argument later. The net result is that there is now little cash flow benefit in any individual entering into a DOTAS scheme, as HMRC may simply open a tax inquiry, issue an accelerated payment notice, and then collect the disputed money in any event. The VESPA contractor strategy falls outside of the DOTAS regulations, and so there is no risk of an accelerated payment notice being issued. Finally, the GAR, General Anti-Abuse Rule, was introduced in the Finance Act of 2013. It does not supersede or replace any of the specific targeted anti-avoidance measures, such as IR35, but rather it sits above them. It has a high barrier to being effective, with the burden of proof being on HMRC to demonstrate that there are tax arrangements which are abusive, and that the proposed counteraction that they are proposing is just and reasonable. Central to the GAR is the concept of a double reasonableness test, i.e., identifying whether the arrangements cannot reasonably be regarded as a reasonable course of action. This is a complicated area, with enough scope for its own webinar, but for the purposes of today, we'll summarize by saying that we've taken extensive advice on the VESPA contractor strategy and are comfortable that it will not be classed as abusive under the GAR. A final note on legislation. This year's Finance Act has introduced a new raft of anti-avoidance legislation. Specifically, new legislation targeting schemes which involve individuals being employed by an employer outside of the UK, targeting structures that are based upon false self-employment, targeting partners in partnerships that are in fact more akin to employees, and new powers for HMRC to issue accelerated payment notices, amongst others. The VESPA contractor strategy has been developed after the introduction of all these changes, is not impacted by any of them, and is completely up to date with all legislation. Clearly, the strategy may need to continue to evolve for any changes introduced by Finance Act 2015 and beyond. The VESPA strategy is not a disclosable tax avoidance scheme. Therefore, HMRC cannot issue accelerated payment notices to demand tax up front. It takes into account the agency, IR35, and MSC provisions, and is not caught by any of them. Vespa does involve loans, but as has been demonstrated by Rangers, a properly drafted loan agreement cannot merely be ignored by HMRC and treated as taxable income, much as they would like that to be the case. All contractors are different. They work in different industries, with different working patterns and different circumstances over how they do their work. As a result, different types of risk will be more or less relevant to an individual contractor. Let's take Brian the engineer, who may be most concerned with the commercial risk associated with his engineering job. So, limited liability status may be the most pressing concern. Whereas David, the IT contractor, is working as part of a wider team with employed colleagues. His most pressing concern may be whether he is truly self-employed for the purposes of IR35. Different individuals have different risk appetites. Some will only sleep soundly in their bed if they know that they've paid all taxes as an employee and will only ever feel comfortable with an umbrella company. Others may be serial users of tax avoidance schemes and feel entirely at ease with the risk of a tax inquiry. Ultimately, it's down to each contractor to assess whether they're comfortable and which options they wish to consider further. Vespa is a strategy for contractors wishing to mitigate their taxes. It is not a tax avoidance scheme that falls under the DOTAS regulations. The world of tax mitigation strategies involves a huge range of advisors that vary wildly in their skills, experience, and the robustness and completeness of their advice. Make sure you know the quality of the mitigation strategy you decide is right for you. The Vespa strategy is built upon advice obtained by Robert Venables QC. Mr. Venables is arguably the most senior and respected tax barrister in the country that advises on these matters. He is the senior QC of Tax Chambers, Lincoln's Inn, London. He is a chartered tax advisor, a fellow of the Chartered Institute of Taxation, as well as being a bencher of the Middle Temple and chairman of the Revenue Bar Association between 2001 and 2005. He is also the author of numerous works on tax, trusts and related topics. Over £1 million has been invested in tax advice from Mr. Venables, which has culminated in the Vespa contractor strategy. Mr. Venables has provided over 200 pages of written tax advice for the strategy, as well as created all of the documentation required to implement it. We are confident that it is the only tax strategy currently being offered to contractors which incorporates all of the changes introduced by Finance Act 2014. Not every contractor can use the Vespa strategy. There are various eligibility criteria that you'll need to meet. You'll need to be a contractor with a current contract assignment or expect to be offered one soon. There's little point signing up to the strategy until you have a potential contract role. You'll need to spend most of the year in the UK. The Vespa strategy mitigates UK taxes, so is suitable for individuals that are UK tax resident. You'll need to have a legal right to live and work in the UK. If you're not originally from the UK, you may require a visa or other work permit to live and work here. As your potential employer, Partners Associates will conduct checks to ensure that you have a legal right to work. You'll need to have a contract or potential contract that is based in the UK. The Vespa strategy mitigates UK taxes, so is suitable for individuals that are UK tax resident. If you have a contract overseas, you may, depending upon the circumstances, become a tax resident of another country and liable to pay tax there. You'll need to be on a rate of at least £175 per day or £22 per hour and full-time. The Vespa strategy mitigates UK taxes, so is suitable for individuals that fall within the higher tax bands. Those on a low rate or part-time contract are unlikely to realise enough of a benefit from the strategy to make it worthwhile. You'll need to have a recruiter and/or client that is VAT registered. will charge VAT on your personal services. The chances are that the recruiter will be VAT registered. However, recruiters in some industries, e.g. healthcare, typically do not register for VAT, and so are unable to work with Partners Associates. You cannot be a construction industry worker. Workers in the construction industry may be part of HMRC's construction industry scheme that has specific tax rules. The VESPA strategy does not work with the construction industry scheme and so is unsuitable for those individuals. In a very rare minority of cases, there may be other contractors that are unable to use the VESPA strategy. This is typically only if they are in very high-risk roles, for which we are unable to obtain insurance. An example may be a nuclear reprocessing engineer at Sellafield. 99% of the time, we can provide full and comprehensive insurance. VESPA is for individual contractors, not companies. Although if you have an existing limited company that has profits to extract, partners are able to offer alternative strategies to help with that. VESPA is based upon the contractor being an employee of a UK employer. The contractor is unquestionably employed and will be subject to PAYE on their salary. The UK employer is named Partners Associates and is based near Ludlow, Shropshire. There is no offshore employer, so no issues with the recent offshore employment intermediaries legislation. The team at Partners Associates will take care of all of the administrative hassle associated with contracting, arranging contracts with your recruitment agency or client, processing timesheets, raising invoices, and processing your payroll automatically. If you decide to join Partners Associates, you will need to sign 2 pieces of paperwork up front, and that's it. The first document is your contract of employment, which is fairly standard and confirms that you'll receive the national minimum wage as a salary. It is this element that is taxable as earnings and subject to income tax and national insurance under PAYE. The second document is a loan agreement. Under the terms of this document, Partners Associates will make a flexible loan facility available to you, its employee. These 2 documents are mirrored by the 2 payments that you will receive on each pay cycle. You will receive 1 net salary payment and 1 loan payment into your bank account. All the payments are made on a same-day basis, so you won't be waiting around for your money. One important element of the tax strategy is that Partners Associates will employ you in its capacity as trustee of a trust. It is this trust that is trading and delivers the services of you and all of the other contractor employees to clients. This is important from a tax perspective, as it means that there is absolutely no question of IR35 applying. IR35 can apply when a contractor delivers his or her personal services via an intermediary. Partners Associates is an intermediary. However, IR35 only applies to intermediaries that are companies, partnerships, or individuals. It does not apply when the intermediary is a trust. As an employee, the primary tax risk will sit with the employer, Partners Associates, rather than with you. So what are the other key features and benefits of the VESPA strategy? Insurance. As an employee of Partners Associates, you'll be covered under their insurance policies and do not need to obtain your own. There is professional indemnity cover of £2 million, public liability cover of £5 million, and employer's liability cover of £10 million, all at no additional cost to you. A dedicated employee relations manager, your single point of contact for any questions or queries. A range of additional benefits are available as a Partners Associates employee, including life insurance and critical illness or income protection cover. There are no joining or leaving fees, and contractors typically enjoy the equivalent of 85 to 88% of their gross contract value after all taxes and fees. The VESPA strategy does not fall under the DOTAS rules, so there is no requirement on the contractors to disclose their use of the strategy to HMRC. Also, as the contractor is an employee, unless you have other tax reasons for doing so, there is no requirement to file a self-assessment tax return, as all of your salary and benefits will be filed under PAYE. Finally, a proportion of the fee will be retained in a ring-fenced account as a fighting fund that will be available in the event that HMRC inquire into the operation of the VESPA strategy. This diagram summarizes the relationships between the various parties. The contractor becomes an employee of Partners Associates. Partners Associates is the trustee of a trust. Partners Associates delivers your services to an umbrella company in the first instance. This is because recruiters typically have preferred supplier lists and won't deal directly with partners. The umbrella provides your services to your recruiter, if you have one, who then provide your services to the ultimate client for whom you work on a day-to-day basis. So, for a contractor that meets the eligibility criteria, what are the steps in the strategy? Step 1. The contractor will become an employee of Partners Associates who are trustees of a trust. Step 2. The contractor will be paid a minimum wage salary and access additional cash through a loan facility. At this point, it's important to highlight the tax consequences of VESPA. There is no question whatsoever that PAYE tax and national insurance is due on salary payments. A contractor may take salaried employment at whatever salary they choose. If they choose to take a low salary and hope that the employer will do right by them in providing other cash flow support, then that is entirely ordinary and commercial. The concept of an employer providing loans to employees is similarly benign and well understood. There is specific tax law regarding how this situation should be taxed, and that is A. The loan is a loan, not income, and therefore the loan itself is not subject to income tax or national insurance. B. If the loan is at a low interest rate, then the discounted interest is a taxable benefit provided by the employer, and it is this benefit that is taxable. What does this mean in practice? Well, if a contractor has received £100,000 in loans over the course of the tax year, and the loans are interest-free, then HMRC will compare the amount of interest paid, nothing, to their benchmark rate, which is currently 3.25%. So, HMRC assess the benchmark interest as £1,625 and will tax that at 20%, which is £325. The net result is that the contractor has received £100,000 in loans on top of his minimum wage salary in exchange for a benefit-in-kind tax charge of £325. Note that this is not tax avoidance. There is nothing contrived in this. The tax is being calculated entirely in line with the legislation. There are no tax reliefs to be claimed, no loopholes exploited, nothing. These are the only steps in which the contractor has to do anything. They are employed, they receive salaries, which are taxed under PAYE, and they receive interest-free loans from their employer. That is it. All of the remaining steps are designed to achieve a certain tax outcome for the employer, but are not relevant for the contractor-employee. Step 3. Partners Associates decides that it wants to create an employee benefit trust for the potential benefit of all the contractor employees, their relatives, descendants and dependents. As previously stated, this does not involve the contractor in any way. Step 4. Partners Associates' business is clearly inextricably linked with the contractor employees and the ability of partners to attract and retain the employees that it has. Otherwise, no business. For this reason, it's perfectly commercial for Partners Associates to decide to make payments to its employees, and this is what it resolves to do. Step 5. Let's fast forward a little to a position where the contractor has been working for some time and has been drawing salary and loan payments. The situation could be summarized by this diagram. The contractor owes some money to the employer under the loan facility. The employer has committed to make contributions to the Employee Benefit Trust. The commitment that the company has made to the Employee Benefit Trust is likely to approximate to the total of all the employee loans made. Step 6. To make good on its commitment, the employer may decide to contribute assets other than cash to the Employee Benefit Trust, or EBT. The main asset that the employer has is the creditor's rights, or right to collect, the contractor-employee loans. Should the employer choose to contribute the loans to the EBT, the net result will be as outlined in this diagram. The individual contractors will no longer owe the employer any money, but rather will now owe the money to the trustees of the EBT. There is no need for the money to move, i.e., there is no need for the contractor to repay the company first and then draw the loan from the EBT. The debt just shifts across from the employer to the trust. From the contractor-employee's perspective, this is a better position to be in. A, because the contractor is a potential beneficiary of the EBT, and the trustees have legal and fiduciary duties to act in the best interest of beneficiaries. And B, the contractor's loan is now away from the, albeit small, risk of the employer getting into difficulty in its trading business. It's important to stress that the loan is a real loan. It does not get written off during the strategy, and at some point it will fall due to be repaid. As with any tax planning strategy, the quality of the implementation is of paramount importance to its ultimate success. The implementation process that we've described is all based upon comprehensive advice from our QC, and he's drafted all of the documentation for each step. If you decide to use the strategy, you will see that the documentation is very carefully crafted legalese to ensure that all of the bases are covered. The strategy is all administered within the UK. There is no cash flying around tax havens or anywhere else. It's always with the UK employer or the UK employee. Finally, the team behind Partners Associates have decades of experience in delivering contractor strategies, so that you can be confident that they fully understand both the strategy and the needs of today's contractors. Obviously, our preference is for contractors to use the strategy for all of their assignments. But in the event that circumstances change, for example, they take a permanent job, then they can be comfortable that they can leave at any time without any charge. The small benefit-in-kind tax charge on the loans that we've discussed will stop in the tax year after the contractor ceases to be employed by Partners Associates. Once a contractor leaves, they are not simply cut loose. It's at this point the contractor will engage with partners' tax resolutions. This is the part of the partner's business which holds the ring-fenced portion of the fees that we discussed. In the event that HMRC ever ask questions regarding a contractor's tax position and their use of the VESPA strategy, then tax resolutions will pick this up and have the conversation on the contractor's behalf. Partners Tax Resolutions is led by Liz Coleman. Liz is a former fully trained inspector of taxes with HMRC. Having worked for the Revenue for over 16 years, she has an intimate understanding of how they work. Since leaving the Revenue to cross to the other side of the table, Liz has represented numerous clients in their dealings with HMRC inquiries. With Robert Venables QC supporting Liz with the technical tax arguments, we're confident that there'll be a formidable team in the event that HMRC seek to inquire into the VESPA strategy. While it's difficult to predict the probability of any given contractor being subject to an HMRC tax inquiry, given that VESPA falls outside the DOTAS provisions, it seems prudent to prepare for an inquiry. You should bear this in mind before making a decision on whether the VESPA strategy is suitable for you. So, what are the fees associated with VESPA? Well, the employer, partners, associates, typically makes a 12% gross margin on the work that its contractor employees deliver. This includes the contribution to partners' tax resolutions that we've discussed. This means that after margin and taxes, a contractor employee typically receives 85 to 88% of the contract value in their bank account. The variation is due to the fact that different contractors are on different rates, whereas the taxed salary element that is paid is fixed. So the higher your day rate, the higher the percentage return you'll see. In terms of expenses, the employer will process any expenses that can be reclaimed from the end client and pass them straight to the employee. As expenses abuse in umbrella companies has been a target area for HMRC, the employer will not pay other non-billable expenses such as mileage to and from work. However, these may still be reclaimable under self-assessment at the end of the year. So, why would any contractor consider the VESPA strategy? As we've seen, all the options open to contractors have been targeted by HMRC at some point, with specific anti-avoidance provisions seeking to extract the maximum tax take from these productive, independent members of society. Each contractor can decide for themselves whether or not they're paying more than their fair share of tax, and whether they're content to use an umbrella company to receive all tax under PAYE, funding employees and employers' national insurance themselves. Each contractor can also take a view on whether they are truly self-employed and how much or how little admin they're willing to take on over and above fulfilling their contract assignment. We've talked about risk and the importance of each contractor assessing their own appetite and where they feel comfortable. One thing is clear. The VESPA strategy has been specifically designed by the top tax minds in the country to avoid the traps in the legislation introduced by HMRC and providing contractors with a new, tax-efficient, low-hassle option, enabling them to focus on their job whilst being comfortable that they aren't paying more than their fair share of tax. There has been much in the media recently regarding tax avoidance schemes, which have varied in quality from the sublime to the ridiculous. The VESPA strategy is not a tax avoidance scheme. The contractor is paying all taxes due on both the salary and loan elements that they receive. They are merely exercising choices made available in the legislation to structure the cash that they receive in that way. We've provided an overview of how the strategy works and how simple it is from the contractor's perspective. All of the complexity is dealt with by the employer. We've talked about the great retention rates available through VESPA. We believe that VESPA offers one of the most competitive returns available. Beware of cowboy operators based offshore offering preposterous returns. In our experience, they often have little or no advice underpinning their purported strategies, and often engage in highly aggressive marketing tactics that will undoubtedly gain the revenue's attention. Finally, we've talked about the aftercare service provided by Partners Tax Resolutions and the support available in the event of a revenue inquiry with ring-fenced funding. Thank you for spending the time to listen to this webinar on the VESPA Contractor Strategy, brought to you by Partners. We hope that you'll consider VESPA as an option for your next contract. If you've heard enough and want to apply, then click on the link which will take you to an application form. If you've any further questions that you'd like to discuss, then please don't hesitate to get in touch either by email or phone using the details on screen.